Good morning. If you are a real estate investor and or a rental property owner, you owe it to yourself to watch this show and learn all about 1031 exchanges. What is 1031 exchanges, you ask? Well, I'm no expert on that. That's why we have David Gorenberg. He's an attorney and a certified exchange specialist. Let us hear from David everything you and I want to hear about 1031 exchanges. David, thank you very much for joining us today.
Bipin, thank you very much for having me.
So, tell our audience about you and then tell them about why they should be aware of the IRS code 1031 and how can that help them.
Well, I'm a Philly boy. I've never lived more than about 15 miles from the Liberty Bell. Um, Lived most of my life in South Jersey. I'm an attorney, a certified exchange specialist. A certified exchange specialist is the only tested professional designation for 1031 exchange professionals. And I've been a full-time qualified intermediary. That's the person who you need when you're doing a 1031 exchange. I've been a full-time qualified intermediary for over 20 years now. That's my practice. I don't do active residential transactions or anything like that. I do 1031 exchanges and nothing else.
So you are an expert on 1031. So that is where, so tell us how property owners, investors can benefit from this uh, IRS code.
So very simply stated, if you own an investment asset and you sell it for more than you paid for it, you have to pay what is called capital gains tax. So let's use the Monopoly board for a moment. If you bought Pennsylvania Avenue for $100 and you sell it for $150, in the real world, you'd have to pay tax on that $50. Section 1031 allows you to sell Pennsylvania Avenue so that you can upgrade to Boardwalk without paying those capital gains taxes and roll that whole $150 into the purchase of Boardwalk.
And this way they can defer those taxes.
You defer those taxes and potentially even completely eliminate them. In order to do that, the taxpayer, the investor needs to do one key thing. They need to be willing to die while they own that last asset. If they die under the current tax code, their heirs will inherit those investment properties at the fair market value as of the date of their death and not have to pay those capital gains taxes that they were otherwise deferring.
So that would happen if the property that was inherited was part of the 1031 exchange, or could that be the property that the heirs could sell and exchange it with another one to become eligible for this benefit?
Yeah, so Grandpa has a series of properties that he has owned and been investing in for years. And if he were to sell it today, let's say that there's $500,000 in capital gains that would have to be recognized. If he instead dies, his heirs would inherit that property at the fair market value as of today's date. They would not have to recognize that $500,000 in gain. They could either keep the properties and continue to use them as rentals, or they could sell them without having to pay that capital gains tax.
That is a great program. And as you said, it has to be done with a intermediary like you who knows the program, who can guide. It is not that you sell the property normally and pick up that money and then you decide to take another purchase. It doesn't work that way.
That
It has to be done uh, properly. And then why don't you explain some of those steps?
So For the most part, the real estate transaction looks like any other real estate transaction. You'll be involved helping your client sell the property. The buyer will have a title company. Everybody will sit down, COVID notwithstanding, at the closing table and take and sign whatever papers. But one of the key components of a successful 1031 exchange is that the taxpayer never touches the money. In fact, they can't even have constructive receipt of the money, which means that none of their trusted advisors can hold the cash for them. The money needs to go to a neutral, disinterested third party. And that's my job. It's my job to be the neutral, disinterested third party. There also needs to be an additional layer of documentation, an exchange agreement, a contract between the qualified intermediary and the taxpayer, and that's another part of my job. So those preparing those documents and holding the cash in a safe and secure manner are two critical components to a successful 1031 exchange.
Absolutely. And then you also mentioned that it has to be completed in a certain time frame.
So yeah, the Internal Revenue Code is pretty clear, and this is black and white. It's not up for interpretation. From the day you sell your relinquished property, you would have 45 days to identify a list of potential replacement properties. And from the day you sell your old property, you would have up to 180 days to buy something from that list. So and the 180 days, I say up to 180 days. If you start your 1031 exchange late in the year, October, November, December, the rule really is up to 180 days or the due date of your tax return, whichever comes first. So if you're selling at the end of the year, it's important that you discuss that with your intermediary so that you can get an extension, so that you can discuss the ways to get an extension on your income tax return and get the full benefit of the 180 days if you will need to do so.
So you definitely don't want to rush into buying something, and if you don't extend your tax filing deadline, then you can't take advantage of this.
That's correct. And you just made a very good point. You said don't rush into anything. We encourage investors to speak to us early and often. Personally, I encourage investors to speak to me right around the same time they approach you about listing the property. It's never too early to start planning, but if you wait until the last minute, you can get yourself caught in a bind.
Right, and then I have had few conversations with you on this process, and I remember you had mentioned that before you put a property on the market for sale, you list it for sale, you should really identify what you intend to buy in exchange.
Yeah, so let me clarify that. Remember, you have 45 days from the date of closing to come up with a formal list that you would submit to the intermediary, and then you would buy from that list. But I try to encourage investors, if you know you're selling your current investment property, start looking for your new property now. There's nothing that says you can't identify your new property before you sell the old property. We both know that right now it's a seller's market. Mm-hmm. And I would be very anxious if I was going to closing on Monday, this coming Monday, and haven't even begun the process of looking for my replacement properties. Because something that's available, well, you and I both know something that just went on the market yesterday, could very well be gone by the close of business Monday.
Absolutely.
So I encourage people to start looking for the replacement properties as early as possible.
Right. Now, again, with the seller's market, if you identify some properties, then you need to kind of enter into some agreement with the seller of that property which you intend to buy in exchange, so that they are aware that you are serious about this, and that you will buy it, because otherwise they may sell it to somebody else.
Yeah, I mean, we know that the process includes submitting a formal written offer. And one of the things I try to encourage investors to consider is don't let the 1031 exchange get in the way of your transaction. For all practical purposes, you're selling your relinquished property the same way you would have sold it otherwise, and you're buying your replacement property the same way you would have bought it otherwise. Just so happens you have some time restrictions involved. But there's no need to let that interfere or cause you angst or anxiety if you're working with qualified real estate agents such as yourself, a good, reputable, qualified intermediary, and perhaps good tax and legal advisors as well.
You need a team, good team on your side, as for any transaction.
Absolutely. I like to think I'm part of a team. I don't ever want to think that I'm the only one involved. Every once in a while, a client comes to us who has a real estate agent but no other advisors, or they have an attorney but no other advisors. And I really do encourage them to have a full team, because even the best quarterback in the world can't win a football game if he doesn't have 10 other people on the field with him at the same time. We don't
Absolutely.
need we don't need 11 for this transaction, but we do need a team.
Right. Absolutely. So 45 days is one of the conditions, and then they also have an option to buy multiple properties for the same price range. Or can you explain that also, please?
Sure. So one of the other critical factors, if you want to fully defer the capital gains taxes, you want to ensure that you are buying property of equal or greater value than what you sold. To do that, you can buy one property if that's what your game plan is, but some people use Section 1031 as sort of an estate planning tool. So let's go back to grandpa again. If grandpa has three grandchildren and he's starting to plan for his ultimate passing, he could very easily sell his existing shopping center. And maybe it's a small shopping center, maybe it's a four-family rental, whatever it may be. He could sell that and buy three other properties, one for each of his three grandchildren. So when he submits his identification, which has to be again in writing and submitted to the intermediary, he will identify that he's either planning to buy one of those properties or maybe he's planning to buy all three, and he's going to articulate that in writing on that form.
Now, you mentioned that if he's planning to buy one for each of his three grandkids, can they be uh, as part of the exchange? Can it be given to three different people?
So that's a very good point to clarify. When he buys the replacement property, so the taxpayer is the person who gets the benefit of the 1031 exchange. So grandpa is going to sell property number one,
Hmm.
and he will buy three different replacement properties, again in his individual name
Hmm.
or in the name of an LLC that he owns. Again, that's something to talk to your attorney about. But he's going to buy the replacement properties, and in his will, he will say that property A goes to Becky, and property B goes to Sally, and property C goes to Charlie.
Hmm.
So that
Right.
upon his passing, each one would get their own property.
So that is called succession planning.
Yes, yes, exactly right. And we have a fair number of transactions where that is part of grandpa's or grandma's or their collective strategy, is planning for what happens after they're no longer here.
Right. Um, One question that I have uh, that has come up during my conversation with real estate investors when I talk to them about this 1031 exchange plan. They are asking, what if we decide to hire an intermediary? They have our money from the settlement of the property that we just sold, and when we are ready for the exchange, those people run away or they don't have the money. How do we know the company that we are trusting is going to be around? I know with you are part of the rheology, which is one of the largest worldwide companies in real and a very reputed name at that. But how do people be assured that they are trusting somebody uh, with that big amount of money?
Sure. That's a very good question. I can tell you from personal experience. Look, I've been in this business for 20 years. I've served on the board of our National Trade Association. I've been president of our National Trade Association. So I've seen some more of this stuff than most other people. In the run up on real estate in the early 2000s, there were people starting 1031 exchange businesses who had no business doing so. And there were in 2007, 8, 9, a few people who, unfortunately, whether they were just bad bookkeepers or they were outright criminals, did disappear with other people's money, or they went bankrupt with other people's money. I haven't heard of anything like that happening in the last 5, 6, 7 years at least, probably longer. But that doesn't answer the question, how do we know that they're going to be around? Well, a couple of things. First, you want to look at who is the company and who stands behind the company. To your point, Realogy is part of the Realogy 1031 is part of the Realogy family. Realogy as a company is the largest owner of real estate franchises in the country, perhaps in the world, I'm not sure. Realogy isn't going anywhere anytime soon. You also want to look at the people with whom you are dealing. So if you go to Realogy1031services.com, and this isn't intended to be a commercial, but if you do go to that website and you look at about our team, I think is what the page is called, you'll see that there are 4 or 5 of us who combined have over 100 years of 1031 exchange experience. And we are attorneys, licensed attorneys. My law license cost me an awful lot of money, and it costs me a fair amount of money each year to keep it active. I have never handled a transaction that had enough zeros on it to jeopardize those law licenses. And I've handled some pretty big transactions. So it's important. You want to look at who the company is. You want to look at who the people are. Are they licensed attorneys or accountants? Because there is no boundary to entry in this industry. The person who did the oil change in your car last month could also be doing 1031 exchanges in the back office if they so chose. You want to also see, are they a certified exchange specialist, or do they at least have certified exchange specialists on staff? Because again, that is the only tested professional designation in this industry.
And what are the pre-requirements to become one, so that people can be assured that they are dealing with somebody who is really well qualified and
So to become a certified exchange specialist, as I said, there's a test. It's a half-a-day test. It's given twice a year. You also need to certify that you have been a qualified intermediary either full-time for the last 3 years or substantially most of your time, I don't remember the exact words, for the equivalent of 3 years out of the past 7 years of your employment. So if you work at a title company, for example, and half of your duties are 1031 exchange related and half of your duties are as a closing officer, for example, then you would theoretically be eligible to take the test after 6 years, because you're only doing half of your work as 1031 exchange and half as title.
right.
So you certify to the experience, you pass the test, and then you have to sign on to say that you will abide by a code of ethics. And I'm on the ethics committee, and we take reports of ethics violations very seriously. We investigate, we provide due process, and we hope to educate anybody who violates the code of ethics more than it's not a punitive system, although punishment is appropriate sometimes.
Absolutely. Um, uh, 2.5 years ago, I was invited to be on the ethics committee of the Tri-State Realtor Association, and having been on that committee, you come across cases where people think that's okay, everybody is doing it, nobody will. After being on that committee myself and attending many hearings, when I see something that is not happening right, I said, I tell myself, if I see somebody in my in in my company or my friends, I, I remind them that that is against the code, and there are severe effects of that. So it is definitely a good thing to be involved with that board, because we are more aware, and we can hopefully prevent those things from happening.
Absolutely. Absolutely.
Now, so we also have a question about. We were talking earlier about uh, they have to buy a property within 45 days, but
Identify.
identify for and but if they want to buy a property before they sell their own, for any reasons, that the property they have identified to buy in exchange, that seller wants to sell it quickly, and you don't want to miss that opportunity. And from my conversation with you earlier, I knew that that was possible. Can you tell us more about that?
Sure. So to your point, there are situations where an opportunity comes to you that's too good to pass up. Grandpa comes to you and says, "Bippin, look, I'm looking to get out of the real estate game. I'll sell you my farm. I- I'll sell it to you at a slight discount if you can close within 30 days. No contingencies." And Bippin, you're a smart businessman. You say, "I can't say no to that opportunity." So you sign the contract, but you don't have the ability to own that property outright while you're still holding some of your other investments. So there is a process called a reverse 1031 exchange. And a reverse 1031 exchange, the process was blessed by the IRS back in 2000. It's a strategy that allows you to own both properties, and I use the word own in quotes. You can buy your replacement property before you sell your relinquished property. Again, you need to get the qualified intermediary involved in the transaction before you go to closing. Again, earlier is better than later. Get the intermediary involved, and the structure involves what is called parking the replacement property, usually the replacement property, but sometimes the relinquished property. You park the replacement property with the intermediary, or more accurately, someone who is called an exchange accommodation title holder, who is often affiliated with the intermediary. And the exchange accommodation title holder will get a loan from you. So, Bippin, you would lend the money to this exchange accommodation title holder. The exchange accommodation title holder will buy the property on your behalf and lease it to you for $1 on the condition that you otherwise pay all of the taxes and maintenance and insurance. And now you're happy because you own this new asset. In the meantime, you've been marketing to sell the other asset that you had that was a little less desirable, perhaps. One of the major advantages, obviously, is you're taking a property, you're getting a property before it was exposed to the market, so you don't have competition.
Absolutely, and during this time, it is so critical.
Absolutely. But the other thing to keep in mind, and this is something that I've been stressing a lot with some folks I've been discussing reverse exchanges with lately, if both of the properties are indeed rental properties, because it doesn't have to be a rental property, it could be a business property, right? If I own David's Landscaping, that property where my backhoes and bulldozers and all of my mulch are stored, that's a business property. That property would also be eligible for 1031 exchange. But if both properties are rental properties and both properties are cash flowing positive, during the time that I own both properties, I'm actually getting double cash flow. So for a nominal increase in the cost of the transaction, I'm doubling my cash flow for up to 180 days.
Absolutely, absolutely. I mean, there are so many things that can be done with this 1031 exchange program that it is good that property owners and real estate investors get a team together, as you rightly pointed out. And you also mentioned during our conversation today that there is a potential to eliminate any tax gain from the sale or exchange of these properties.
Yeah, so in most 1031 exchanges, you're selling your property, you're selling property number one, you're doing a 1031 exchange, you're buying property number two. And then you would do it again a few years later, you would sell number two and buy number three. And if at the end you say, you know what, I'm going to just sell number three outright, then the tax that you avoided on number one and the tax that you avoided on number two, and now the tax on number three would all have to be paid. However, if the investor continues either doing 1031 exchanges or finally gets to that last property and does not sell, then upon his death, his heirs will inherit the property. And depending on what his will says, whoever gets the property would inherit that property at the fair market value as of the date of grandpa's death under the current tax code. Now, that could obviously change, but under the current tax code, grandpa dies, heir receives the property, fair market value. The gain from number one goes away. The gain from number two goes away. The gain from number three goes away. Now, there is a caveat I need to mention here. For Pennsylvania state income tax purposes, Pennsylvania does not recognize Section 1031.
Oh, really?
So, but that's okay. In the giant scheme of life, Pennsylvania's state income tax is pretty small compared to some others, right? The tax rate is 3.07%, right? New Jersey can be double that or more. In fact, it can approach triple if you're in the highest tax brackets. So in Pennsylvania, if you had $100,000 in capital gain on that first property, when you do a 1031 exchange at the federal level, you won't pay income tax, you won't pay capital gains tax. But at the state level, because there was $100,000 in capital gain, you'll pay $3,070 in state level capital gains tax. In the giant scheme of life, that's not so bad.
Right. And I also remember that when you are selling this investment property that you have had for years, you you get you collect depreciation, and that also comes into play when you are finally disposing of that last property.
Yes, again, so with 1031 exchange, each time you do an exchange, you also avoid, for the purpose of that transaction, the depreciation recapture. Depreciation recapture at the federal income tax level is 25%. And so if you took $50,000 of depreciation on that last property while you owned it, you would own $12,500 in depreciation recapture taxes to Uncle Sam. Again, Pennsylvania is not going to recognize Section 1031, so you'll pay the 3.07% on the 50,000, but it's still better than paying the 25% to the feds, right?
Right.
You do a 1031 exchange. When you die, all of those taxes that you were deferring along the way will disappear. Your heirs will inherit tax-free. The taxes that don't go away because of Section 1031 really are, regardless of what state, you're still going to pay transfer tax, right? That's the equivalent of a sales tax. You're still going to pay the transfer tax. In Pennsylvania, you'll pay the state level taxes. Most other states, it all gets deferred.
Right. Um, so, David, I was reading that the 1031 exchange section was written into IRS code 100 years ago in 1921. So this has been around for 100 years. That is unbelievable.
Yes, it's a 100-year-old statute. The number has changed a couple of times, but the statute has been in existence for 100 years.
So I really appreciate you coming in today and give us a rundown on how real estate investors and property owners and landlords can take advantage of this amazing IRS gift. Remember, you never get a gift from IRS, but this is one program that really done right can save you tons of money, and you owe it to yourself to learn about it. So, as we come to a close, can you explain the main features of this program in in a few minutes, so that as a summary, people can review it?
Sure, I can explain it in probably one or two sentences. Section 1031 allows businesses or investors in real estate who have built-in gain in the property because it's worth more than what it when they paid for it, when they bought it. It allows them to play monopoly with those real properties and real dollars and avoid paying capital gains tax and recognizing depreciation recapture when they sell Pennsylvania Avenue to buy Boardwalk. It really is that simple. There are some milestones you have to meet and some check boxes you need to comply with. That's my job to ensure that we take care of all of those. And we provide free consultations to folks all the time. So I'm looking forward to speaking with you, Bipin, your clients, and the folks who are listening to us today.
Right, and you know, I'm a real estate investor first before I became a realtor. So I've been buying and holding mostly for the last 10 plus years, and I've been talking about passive income generation techniques using real estate property purchases and flipping properties, and I think this is one of the best ways to build wealth and pass it on to the next generation. And when done right, using this amazing tool, 1031 exchanges, you owe it to yourself to do it right and work with a team of professionals who know what they're doing, and just build your wealth. And it's a great way for succession planning.
Absolutely. Absolutely.
So again, I want to thank you, David, for coming on the show and giving some amazing information to our viewers. We do this show every Saturday at 10 o'clock, where we bring in either local small businesses, community organizations, and experts like you, professionals like you, to talk about how people can make things better, how they can make money and keep more for themselves, rather than, we all have to pay to the Uncle Sam, but there are tax advantages that we should be aware and we should be able to take advantage of, so that we do these things right and build wealth for ourselves and for our heirs.
Absolutely.
Thank you again, David. Appreciate you joining us this morning. I hope you have an amazing rest of the day. Stay safe, stay warm, and I will talk to you very soon.
I look forward to it. Thank you again for having me.
Thank you. Bye bye now.
Bye bye.